I don't think anyone expected Enron to go to zero. And I remember when Enron was falling, and if you don't know Enron, at one point it was the, I believe, 18th largest company in American energy company out of Texas. But I remember when Enron's price was falling and the whole way down, all the way to zero, I remember Merrill Lynch giving, buy targets like, well, now's the time to buy. Well, now's the time to buy. Well, now's the time to buy. And as it fell from $90 to zero, I think there were 14 recommendations from Merrill Lynch to buy Enron all the way to zero. And I think the last time Merrill Lynch recommended buying Enron was at, I think, $7 a share. It then went to zero. The point of bringing up Enron is two things. One, it's really hard to believe things can move much, much, much farther than you could ever believe, right? Because we humans, we want certainty, and we want certainty because we want safety. At the core of who we are and how our brains work is we want to feel safe. So everything we do in our life is designed around how to keep us feeling safe. And that's why certainty is so important when it comes to investing. So when Enron was dropping to zero, people were looking to feel safe, and they couldn't believe that a company of that size could actually go to zero. The point is that investments can go much, much lower. Actually, not just investments, but commodities, sectors, indices, stocks can go much lower than we could ever imagine, and actually much higher than we could ever imagine. And there's been one particular sector or type of investment that is going in a direction that I don't think people thought it could go, and it is going much lower. And I actually want to talk about that sector with you, or that investment with you, and how that actually impacts your life. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is, how low can they go? So the question is, what is they, and really how low can they go? So we're going to talk about something really, really sexy and exciting, and we're going to talk about treasury bonds. Specifically, we're going to talk about treasury bonds from the US, Japan, and Germany. And the reason I've picked those three countries is because those three represent the largest bond markets in the world. So on the screen here, you see a price chart of what a 10-year treasury is yielding today. And this price chart goes back to the very end of 2004. So we've got about a decade of information on this price chart. And you see two squiggly lines on the price chart. The red one is a 50-period moving average. And in this case, the period is weeks. So that is a 50-week moving average. And what's nice about showing it on here is that at the very end of the price chart, you can see that this 50-week moving average is actually moving down and falling, and it was actually moving up since about mid-2013, but has since turned down. And yields on the 10-year treasury are falling. They stopped going up in 2013, 2014 at 3%, and since then they've been falling. And today a 10-year treasury yield in the US is 2.2%. which by itself seems ridiculously low. But as you look at this price chart, you can see that generally speaking, the yield on the 10-year treasury has been falling. And it's going to continue falling. Now, when the yield falls, that means more money is going into it. So who the heck is putting money into the US 10-year treasury? And the answer is a lot of people. And the reason a lot of people are is because of this price chart. Now, this is a price chart of the German 10-year yield. Now, this price chart goes back to 2008, right? So we have about 6 years of data here, 6 or 7 years of data. Now, notice that this thing is absolutely collapsing. It is broken below its 2012 and 2013 support, or its floor right there. It is just absolutely broken right through that. And today, if you want to give the German government money for 10 years, the German government's going to give you back an incredibly low, crappy yield of 0.62% for them to hold your money for a decade. Now, what's most important about this price chart is the direction it's moving, clearly down, and its broken support. Whereas when I showed you the U.S. price chart of the 10-year yield, there's still a lot of support that this yield has to get to, and it has to break below that 2012 low of about 1.35% yield. So the German yield is absolutely collapsing. People see that Mario Draghi, the equivalent of Janet Yellen, the European Central Bank chair, he wants the euro to get cheaper against the US dollar to help out exports. So that is also why people are driving money into the German Bund, which is what it's called, because people are scared. Again, when the yield is falling, the price is going up. The price only goes up because someone or something is buying it. Now, you think this is bad. Then we go to Japan. Japan's even worse. The 10-year yield on the Japanese bond is 0.36%. And that is also collapsing, and that is also going down for the last 7 years. And notice there is nothing below it. It is broken below its 2013 low, and it is continuing to fall. Oh yeah, the little red dot is where it was at the beginning of the year. So what we've got is the three biggest bond markets in the world, the 10-year Treasury, which generally speaking is the most followed yield in the world. The 10-year yield is controlled by the world's population and not by governments, meaning the market has more control over the 10-year yield than anyone else. Now, if you go to a 2-year or a 1-year or a 90-day, the governments have more influence over those shorter term yields because it's close to what they have more control over that short end. But you get up to 10 years and they're not. So you may be thinking, well, RC, what is the 2-year yield in the US and in Germany and in Japan? Well, in the US will give you 0.67% yield if you give them your money for 2 years. But in Germany, the yield on a 2-year is negative 0.09%. And the yield in Japan for 2 years is a negative 0.04%. So you've got Japan and Germany giving you negative interest rates for them to hold your money for 2 years as they destroy their currencies. What this means is we live in a closed system. We can't go outside of our solar system or our local cluster to another galaxy and invest or another planet. We're stuck with what we have here on planet Earth. So in many ways, things are very relative. And that means yields are falling because Japan and Germany and the US and China and other major countries, they're really worried about all the debt they have, and they have to keep yields low if the other major countries are keeping yields low. Okay, so that's kind of the boring talk. I mean, it's kind of exciting in a sense that this has never really happened before. But the question is, what does it really do for you, and how does it impact you? So here's the takeaway. Falling yields equal more room for stocks to run higher. And stocks, at least in the US, have hit lifetime highs this week again because there's very little competition right now against stocks. Bonds are yielding less and less each quarter, and people are putting more and more money into this US stock market. As bonds fall around the world, and as the euro falls and as the Japanese yen falls, the US dollar is going higher, which is strengthening the US dollar, which is strengthening US bonds. So that is giving more room for stocks to run, especially in the US. It also means utilities are going to outperform. Now, utility sector has been underperforming for years, but this year it is killing the market, and it is starting to outperform. And I think it will continue to outperform in 2015. So a nice way to do that is just to own a nice ETF that has exposure to the bond market. And again, people usually look to, people are going to look to the utilities market to outperform. People look to utilities because they pay a higher yield and they're a safer place. And in fact, utilities are outperforming the bond market. So that's going to be more room for utilities to outperform the stock market. It's also going to mean there is a high chance that the US dollar is going to move higher. Now, the US dollar from 2002 to 2000, I'm going from memory here, to 2006 fell, and it has just retraced 38% of that fall. So we're just at that 38% retracement. Now, the fall was pretty impressive, about 40-ish percent, 42%. And the US dollar has just retraced 38.2% of that. The reason that number is important is that is a Fibonacci retracement line. So we'll watch to see how much higher the US dollar is going to run. But with Japan killing and crushing and destroying their currency, and with Germany, really Germany, needing a cheaper currency, that means the last standing currency right now is the dollar, and it's going to move higher. So there's more room for the US dollar to rise, which means there's more room for gold to fall. Generally speaking, the thing that moves the price of gold is the change in somebody's concern. And right now, people's concerns are not increasing. They're actually decreasing. Now, my long-term fundamental view on what gold will end up doing in this 18-year secular bear market is going to do has not changed. But we are in a 39-month, now entering the 40th month of a downturn. A path of least resistance is down for gold. And with the US dollar going higher, and with interest rates falling, and with utilities going up, it's going to be harder for gold to find a reason to go higher. And so I think it's going to continue to languish and fall until there is a dramatic reason for it to move up. Now, guys, really what we're doing here is we're looking and saying, hey, here's the big picture. How does that influence your portfolio? How does that influence the stocks and the commodities and the sectors and the indices you own? And this is really just one step or another step in securing your own portfolio and your future. Until next time, this is RC Peck.